Welcome to the Trestle Bridge Capital Market Observations Call for the week of November the 14th, 2022. I'm your host, Eric Jefferson, and before we dive in here, I have a few quick words from the lawyers. With that, we'll get started by recapping last week. I saw the S&P 500 rise almost 6%. That was following a softer than expected CPI report on Friday. That also sent the bond market higher, result of following yields. So starting there, we saw, headline CPI month over month up 0.4%, 7.7% year over year, as well the core reading, which strips out more volatile food and energy. That was up 0.3 and 6.3% respectively. All of those readings better than expectations. So not only did we get positive progress with respect to inflation coming down, but even coming down relative to expectations. As we unpack that even a little further, looking at the core month over month increase in CPI, that was completely attributed to rising shelter costs. If we actually stripped those out, inflation would have been negative on the month over month basis. Reason that's important is because shelter costs tend to be on a lag. Again, we haven't seen those costs make any significant move downward as of yet. So assuming that is in fact the case, I think it's then a fair assumption to believe that inflation has in fact peaked. The question now, though, becomes at what pace does it continue to slow? And more importantly, what is that end destination? As we've talked about for a while now, the number one factor driving capital markets will be the Fed policy with respect to interest rates. That is obviously highly impacted or driven by the outlook for inflation, as well looking at the strength of the labor market. But nonetheless, it was great to get some good news there. Obviously, inflation had been somewhat stubborn over the last several readings. That being said, it didn't take a while for Fed governors to come out and reiterate, again, the emphasis that we still have a lot of work to do. Great to celebrate. We have arguably seen a peak, still a lot of work to do getting back to those longer term averages. Before we move on, final thoughts, sort of recapping the broad economy though. Fair to say we are not in a recession today, but as we've talked about week after week, a lot of those leading economic indicators do suggest momentum is stalling out with respect to growth, something that will certainly weigh on capital markets as well as the consumer, two very important themes as we think about the outlook for next year. Speaking of 2023, we actually had one of the first big names at the big investment firms come out with their year-end price targets for capital markets. Interestingly enough, the outlook for the S&P 500 in line with where we are trading today. And then when we think about what drives stock prices, typically it's either the earnings they generate or the multiple that investors are willing to pay for those earnings. Multiples tend to be inversely correlated with interest rates. So the higher the rates, the lower multiple investors are willing to pay. And with the expectation rates aren't moving lower anytime soon, I think it's fair to say any growth we receive next year is going to be a function of those earnings. That puts that much more emphasis on, again, what a company is able to generate in profits. We're also seeing that confirmed as we wrap up the Q3 earnings cycle here. Stocks that have beaten expectations have been rewarded handsomely relative to those gains in prior years. Vice versa, companies that have missed have been especially punished this go round. Again, I think it speaks to the importance of what is a company doing. That is a theme we certainly believe in and have positioned portfolios to emphasize those higher quality companies with stronger balance sheets, more sustainable earnings, knowing the emphasis there will only continue to increase versus some of those arguably more speculative segments and sectors of the market. Turning to the geopolitical front, we saw Russia announced a troop withdrawal from one of the recently annexed regions. There's no way that could be classified as anything but a major defeat for Russia. Hopefully, though, that moves us closer to a peaceful resolution versus an escalation. We also have the G20 this week. President Biden and China's Xi Jinping will be sitting down for a one-on-one conversation. no set agenda or joint statement afterwards, but hopefully at the end of the day, that's a good sign if the leaders of the two largest global economies are engaging in conversation. And on the topic of China, interestingly enough, we've seen their markets rally over the last few weeks here. One, they've added a ton of stimulus to their beaten up real estate sector. But two, despite rising COVID cases, we've seen them come out and actually cut some quarantine times, been a little more lenient with respect to lockdowns. Again, China has for some time doubled down on their zero COVID policy, meaning they're restricting their economy in order to curb the spread of inflation. There's some rumors those policies were going to be unwound. Came out time and time again, reiterated that is not the case. Though interesting now as we start to see a little break between the rhetoric and their underlying policies. Obviously, if China did come back online, that would be a major positive catalyst for the global economy. Something obviously watching very closely, and at this point still do not maintain any direct exposure to China via our tactical portfolios. And then finally, the main political story from last week, midterm elections. It does appear that Democrats able to hold off the red wave, at least in the Senate, where they're expected to maintain the slightest of majorities. House likely will flip to the GOP, still have a dozen or so undecided races at this point, but GOP only needs to pick up a fraction of those to gain a majority. One theme I want to dive into a little more detail on. We've talked how historically divided government, the executive and the congressional branch, typically good for markets. The thought process being there, if times are good, companies are more apt to go out to spend money, to hire more workers, to build additional plants, if they are less worried about any regulatory changes or additional taxes coming down the pike, which a split government typically decreases the probability of. The one scenario where divided government doesn't necessarily work on your behalf is when times are maybe not as great and you need some sort of legislation a la stimulus in order to jumpstart the economy. Obviously, we have talked time and time again, although we're not necessarily in a recession today, a probability we may get there at some point in the future. And so having that divided government does actually raise some concerns. The other thought there, where the House of Representatives is tasked with overseeing the federal government's budget. Now having a divided government, does that increase the probability of any sort of debt ceiling, government shutdown, debate? We have experienced that, and historically not a positive catalyst for markets. Again, not there, at least at this point today, but something we'll continue to watch very, very closely. Related to that, or something that increases the emphasis there on being able to pay our debts, is the fact that for next year, we are on pace to spend over $1 trillion in interest. That is a function of us continuing to borrow and expand our balance sheet, now coupled with a significantly higher interest rate environment. Again, the argument historically, as we continue to borrow, is that interest rates were near all-time lows. So the debt service, or the amount of interest that we paid as a percentage of our GDP, was very small relative to prior periods in history. Unfortunately, though, as interest rates have ticked up by a historic margin, that cost has moved in lockstep with higher rates. That argument of lower debt service seemingly run out of legs at this point. And then in other news, a very volatile week in the crypto markets. One of the exchanges actually declaring for bankruptcy. That's created a lot of volatility. You talk about having a rough week, as the founder of one of those exchanges did. Saw their net worth decrease from $19 billion to zero in the matter of a few trading days. Again, talk about very difficult week, the volatility and some of the challenges in that space. That's all for now. As always, happy to discuss anything in more detail. If you don't connect, have a great rest of the week. Take care.